Many of us have this picture in our heads about retirement. You hit 65, your schedule clears up, and your healthcare costs drop to a low, predictable monthly rate, thanks to Medicare. But for high earners, that expectation is a trap. Medicare is a wealth-tested expense, where the price you pay is tied directly to the assets you've accumulated. To be fair, Part A, which covers your hospital visits, does live up to the free expectation, provided you have a 40-quarter work history of paying Medicare taxes. But that complimentary coverage stops at the hospital door. For everything else, doctor visits, outpatient care, and prescriptions, Medicare functions as a hidden wealth tax for affluent retirees. That tax is called IRMAA. It stands for the Income-Related Monthly Adjustment Amount, and it is a surcharge applied to your Part B and Part D premiums if your income crosses specific thresholds. You won't even write a check for it. The government automatically deducts this penalty directly from your monthly Social Security benefits. And here's the catch: the 2-year look-back rule. The government evaluates your past income, not your current retirement income, to set your premiums. To put that in perspective, the financial decisions you make on your 2024 tax return dictate the IRMAA penalties enforced in 2026. Large distributions or taxable events at age 63 lock in mandatory healthcare penalties before you ever even apply for Medicare. Let's look at the actual numbers for 2026. The standard Part B premium for most Americans is $202.90 a month. This official 2026 Part B premium table outlines how costs scale by income. At the baseline, individuals making $109,000 or less pay the standard $202.90 rate. But look at the top bracket. Cross into the highest income tier, and your monthly premium jumps to $689.90. This is a jump from roughly $2,400 a year to over $8,200 for the exact same coverage. High earners pay 340% more. If married, these premiums are assessed per person. For a couple in the top bracket, the cost doubles. Passively taking retirement income can push high net worth couples into an extra $11,000 in annual healthcare expenses that they likely didn't budget for. The trigger for these penalties is a metric called Modified Adjusted Gross Income, or MAGI. Every distribution from a tax-deferred account, like a 401k or traditional IRA, inflates your MAGI. Mandatory minimum distributions, pensions, and taxable Social Security benefits stack on top of those withdrawals to push income higher. Once those combined income streams push a joint filing household over the $212,000 threshold, you lose your standard premium status. Treating all retirement accounts as equal and taking standard distributions virtually guarantees you will pay the highest price for government healthcare. You might think you can just delay Medicare to avoid the hit. This brings us to the initial enrollment period. This official calendar shows your enrollment window. It opens 3 months before your 65th birthday and closes 3 months after. It is tempting to look at those IRMAA premiums and simply delay Part B enrollment to dodge the bill. If you delay without having creditable alternative coverage, Medicare adds a compounding 10% late enrollment penalty to your monthly premium. Skipping enrollment without an approved alternative results in a permanent percentage-based penalty stacked on top of your already inflated high-income premiums. Pre-retirees face a choice: pay taxes on your terms now or pay IRMAA surcharges on the government's terms later. The so-called passive planner takes no proactive action before age 63, allowing their tax-deferred accounts to dictate their retirement income. The result is a high MAGI that triggers IRMAA surcharges, which permanently reduces the net value of their Social Security checks. The active optimizer shifts assets before the 2-year look-back begins. They use Roth conversions and tax loss harvesting to create non-taxable income streams for the future. Proactive financial structuring is the only legal mechanism to shield accumulated wealth from these healthcare surcharges. This chart maps the relationship between planning effort and premium savings. Relying on standard distributions requires minimal effort, but yields zero IRMAA savings. Strategies like Roth conversions require more coordination, but create premium reductions that can add up to 6 figures. Because IRMAA brackets adjust with inflation and premiums rise annually, these surcharges act as a permanent drag on portfolio performance. For high net worth individuals, managing Medicare premiums is a core wealth preservation strategy that requires execution years before retirement begins.